this video, I'm going to discuss one of the best investment strategies of all time. This strategy will beat out all the hot shots on Wall Street and will beat out almost all other investment strategies. It's called dollar cost averaging and it's going to change your life. Hello and welcome to another video. My name is The Shiminator. This is my new setup. I know it's been a while since I made a video, but this video is incredibly important because I do believe it can add real value to your life. That's because investing can be really complicated, but the truth is the best investment strategies, the one I'm going to discuss in this video, is so simple and easy. And once you realize how simple and easy it is, you're going to be able to calculate how much you'll have in retirement and even just 10 years down the line. And you're going to see that it's tremendous. It's such a cool thing and it really could make a big difference on your retirement portfolio and also honestly even before that. Now, dollar cost averaging seems like a super easy strategy because all you're doing is buying a set amount at the predetermined set amount of time. So for example, you buy $1,000 a month or you buy, let's say, $100 every 2 weeks in X investment. It's that simple. But there's a reason it works, and I'm going to show you an example of why it works better than other strategies. Let's say that you have person A, which is my left hand, and person B, which is my right hand. Now you might see it the opposite because of the camera, but person A and person B are not the same. Person A is able to go back in time, zap out, and all of a sudden they're going back in time and able to buy every single dip. They're able to go back and buy every single time the stock market crashes. Person B does not have this ability. Person B has the same amount of money, but starting at the exact same time that he goes back to, person B will buy exactly the same amount consistently every 2 weeks or every month. Now you would expect that person A, who has a time machine and can buy every time the market crashed, is going to win. And person B, who has no clue when the market crashed and is buying consistently when the market's doing well and badly, should be doing pretty badly, at least compared to person A. But the truth is that person B is going to be doing better, and I'll explain exactly why. Now person B buys consistently without even looking at the market, but person B wins because they have a lot more money in the market, and I'll explain how that works. Every time person B buys the market, person B is buying a certain amount of stocks or ETFs. Now person B is getting a lot more of those ETFs in a shorter amount of time. That's because every 2 weeks they're buying a certain amount. Now they're going to be able to benefit from dividends and growth, and let me explain to you why. First of all, growth. Most of the growth, especially the big growth in the stock market, happens in massive bursts like fireworks. Now person B is buying in consistently. That means that let's say that there's a few times in the year or a few times in history where the stock market all of a sudden explodes upwards, and it does do this. Now because person B is consistently buying, person B gets all of that growth when the stock market shoots upwards, and it rarely goes back down to previous levels. That's because let's say the S&P 500 consistently grows 11% overall. That means that if you give a 10-year period, it's probably going to be way up, if not doubling more than once. That means that person B is getting all that growth because they're in the market, whereas person A may have some of that, but they may have to wait 5 or 6 or even 10 years for a big drop. And that means their money is sitting on the sidelines, not getting those fireworks. So the first reason is growth. When you have dollar cost averaging, even if you could buy the dip, by not being in the market, you're going to miss out on some massive fireworks that you lose out on gains. Now, even if the market dips 20% later and person A is able to buy in a lot, they're not going to be buying in at the same price that person B has consistently been buying in before those fireworks. Now, the second reason, and that is dividends. When you have money in the market, many companies pay out dividends, and this includes ETFs that hold those companies. Now, when you get dividends and you reinvest those, let's say you get 20 cents a share on a certain company, when you reinvest that 20 cents, you're able to get more of that stock. So you're buying 20 cents, 20 cents, 20 cents every time you get a dividend. And those dividends are also creating dividends when you reinvest them. So think of it as $1, and that dollar creates pennies, and then as those pennies get reinvested, they create pennies as well. Now, it may seem like only pennies, but the more you put in, the more those pennies turn into dollars, which then turn into more dollars. And that is the beauty of compound interest. So it's incredibly important to reinvest your dividends so that you get more and more and more money. You make the money work for you, and that money works for you, and that money works for you, and as it grows out, it grows compounding, which means you could end up with an enormous fortune. B gets that, A does not get that. And that's because person A, who's able to buy all the dips in history, is not able to get that compound as well because they're letting money sit on the sidelines, ignoring the growth and also missing out on a lot of the dividends. So now that I've explained to you why this would beat out a time machine, it's very simple to see why it would beat out a normal person. That's because you not only have to time buying and selling if you're trying to time the market, but you'd also have to be able to buy back in on time. That means that even if there's a massive crash and you think, oh, I know I'm going to be able to buy all the dips, the truth is you might be able to sell the right time or buy at the right time, but you're never never going to be able to do both at the same time and correctly. It's almost impossible to time the bottom, and you're certainly not going to be able to time the top and the bottom together. So the best strategy is to buy in consistently no matter what the market is doing. Now, I'm not saying you shouldn't buy stocks or ETFs when the market is crashing. I'm just saying that if you consistently buy no matter what, you're going to be getting those massive dips, but you're also going to be getting all the growth that comes with time. There are a couple of tricks to dollar cost averaging that can make your life a lot simpler. First of all, make sure you choose something like M1 Finance or a robo-investor that allows you to automatically invest without thinking about it. For example, me, I use M1 Finance and it automatically pulls out a certain amount of money every 2 weeks, every Friday into the market. That means that no matter what happens and no matter what the market is doing, my portfolio is growing bigger and it's gaining all of that growth from buying the dips, from buying normally. It does not matter. If you're consistently putting into the market, you're going to be ahead. Now, this is incredibly important. When the market crashes, you could buy the dips, but keep in mind, you never know where it's really going. You only know that eventually it's probably going to go up. And that means that if you buy now and you buy later and you buy every 2 weeks, you're going to be ahead almost no matter what. Now that you know that dollar cost averaging is so useful, there's something else you can do to shoot this even further into massive profits. And that is to use one of the most underplayed and undervalued investments, even though everyone talks about it, the Vanguard S&P 500. Now, you may have heard of SPY, which is an alternative to that, but it actually does have higher fees and lower dividends. And so VOO is a better investment strategy. However, you don't have to use VOO, and I know off the top of my head that there are a few ETFs that actually perform better than VOO long term, but the Vanguard S&P 500 is way underrated, even though a lot of people talk about it. People think that it's a boring average, but what they don't realize is that the S&P 500 contains 500 of some of the best stocks in America, and when they don't do well, they get replaced by something else. Now, VOO has low fees. That means you're getting access to them extremely cheaply, and because it has some of the hottest stocks that continue to do well, you're going to do well overall long term. Now, of course, VOO seems weird, like why would you want average? But the truth is you can supplement this average, which performs extremely well long term, with other investments like leverage ETFs and other things that we won't discuss in this video. But the key here is that if you're being smart and you're dollar cost averaging into something like VOO, not only are you going to have an incredibly good future and a bright retirement, but you might even have it before that. That's because if you use something like M1 Finance to dollar cost average into an investment like VOO over time, you're going to have a portfolio line of credit with relatively cheap interest rates on that portfolio, and you'll be able to borrow money if needed without selling your investments. Instead, you can borrow money, you don't have to pay taxes on that money, and you can of course go back and pay it off quickly and continue to accumulate wealth. Now, I would not necessarily recommend doing that, but it's nice to have that option where even if you invest a lot, you'll still have access to cash and you'll continue to get the growth and the dividends of investing and dollar cost averaging. So dollar cost averaging pretty much wins. There's almost no question about it. Now, of course, quant investors can sometimes win, but they have to put in trillions of dollars to make AIs that can predict the market, and even then, they often have massive losses, so it's really not worth risking, especially if you're not a millionaire. So if you want to be a millionaire, you pretty much have to dollar cost average into VOO. Now, of course, there are other things you can supplement it with, like I mentioned, but VOO and dollar cost averaging is going to win. And the cool thing is, it takes away a lot of the stress. You don't have to buy the dips. You don't have to try to calculate when's the best time to buy. You just continue to buy. You continue to accumulate. You continue to get tons of dividends and growth. And even when the market is down, like this year, you're going to be able to buy a ton during that crash. You'll buy it at a discount, but you're not thinking about it. It's automatic. And because of that, when you end up retiring with millions of dollars in your account, you're going to thank yourself for doing it passively, automatically. Pay yourself first, and you'll be able to retire with a nice nest egg. So I hope you enjoyed this video. Please give it a like, subscribe if you haven't already, and look out for more videos, because now that I have a studio, I can actually make some nice videos, and of course I'll get better at editing and better at making videos. The market's crashing, and I just really want you guys to be able to take advantage by dollar cost averaging, by taking advantage of every single dip and without worrying about it, which is something I worry about because honestly I want to retire with a few $1 million. Thank you very much for watching, and have a beautiful day.